Hey, welcome back to second part of chapter 7, which we covered last time in part 1, a few sections. Now let's go for part 2. In this part of section 7, I might read one of these scenarios. So Gene is self-employed. In 2022, he reimburses an employee $10,000 for travel expenses and $2,000 for meals under an accountable plan. That is the key word, okay? So if the company has an accountable plan, Gene can deduct $10,000 as travel on Schedule C and $2,000 as deductible meal in line 24B. The employee reports no gross income and claims no deduction for these items. After 2022, remember, the meal was 100% only in 2021 and 2022. After 2022, starting 2023, we are back to normal, which is 50% of meal, okay? Okay, so same fact in example 12, but this time we have non-accountable plan. So if it's a non-accountable plan, Gene, as a self-employed, deducts all $12,000 as wages on Schedule C that he paid to employee. The employee is taxed on $12,000 income, but cannot deduct the travel and meal expenses as miscellaneous itemized deduction, subject to 2% AGI floor, as these deductions are suspended until 2025. Remember, between 2018 and 2025, we changed the Schedule A little bit, increased the personal standard deduction. Personal deduction has been canceled, but standard deduction has been doubled, and Schedule A has been a little bit changed. One of those changes is there is no miscellaneous itemized deduction for travel expenses. So the travel expenses includes transportation, dry cleaning, lodging, meals. But meals is subject to limitation, okay? For year 2021 and 2022, if you order your meal or eat your meal in a restaurant, it's 100%, but that was during COVID. Other than that, starting 23, we'll come back to 50%. Car expenses, car rentals, telephone, bags, and tip. Those are all travel expenses. Okay, so let's read this, it's important. So some employers use the per diem approach to reimburse employees for the cost of meals and lodging. Employers deduct a reimbursement based on a per diem amount as travel and meals, but deduct only 50% of per diem meal allowance. The rule regarding the use of per diem in lieu of actual expenses for meals also apply to sole proprietors. However, the per diem for lodging can only be used for purpose of reimbursing employees. When the owner of the business is away from home overnight on business, the owner must deduct the actual cost for lodging. So if it is overnight away from home, actual cost for lodging should be deducted. And U.S. Service Administration, GSA, sets the rates for coming calendar year, and it changed every year. So you can get the per diem information on General Service Administration website. Okay, so let's continue on that. Let's say this example, that Blake attends a 3-day seminar in Boston. After the seminar, he stays another 5 more days to visit. So Blake spent $450 on airfare, $250 a night for lodging, and $100 per day for meal. Because Blake's domestic trip was not primarily for business, because he was there for 5 days compared to 3 days for business, the cost of his airfare is not deductible whatsoever. Make sense? So if you go a business trip, let's say if the seminar is 3 days, you might stay another day for a personal day as a fun, or another 2 days, but don't stay longer than that, because then your air trip will not be used for the deduction. He can, however, deduct the hotel expenses for the 3 days and 50% of the cost of the meal for 3 days. Make sense? Yes.
What if he, go ahead. No, you go ahead. The taxpayer deducted 50% for meals, or do you just put the 50%?
50% of meal. Let's say meal is $100 per day in this example. So $100 times 3 days business is $300. $300 times 50% is $150 meal.
But in taxpayer, do you put the 300 or you put 150?
You might put in the description 3-day business times $100 times 50%, and then put 150 in the box next to it. So where the box is, you put 150, but in the description, you might want to put something like that. That will kind of reduce the chance of getting audited, because they see, oh, this guy is like, he knows what he's doing. It says exactly 3 days business times $100. And normally your meal is maybe not $100 exactly, because you know how much it is. Here it's just a simple example in the book, but let's say your meal is $250. So you say $250 meal times 50%, and then put $125 on the box next to it.
Sorry, one follow-up. You add the tip?
Yeah, whatever you paid, you have a receipt. Yeah. Remember when you get a receipt, it says $30 keep, $33 charge, and you normally sign that. You keep a copy for yourself, and yeah, keep is included. Yes, it's part of meal cost. Your question, please. Forgot already.
I was so invested in listening to your explanation.
Yeah.
Let's say Blake went to the 3-day seminar, and then he stayed, I think you said it was like 3 days extra he can stay, or 2 days?
I think less than, make it 2, I just say make it 2 days extra day personal, so your business day is more than your personal day.
What if instead of going back home, he goes somewhere else, like to another
business,
or like another city, just
for what?
Himself, not another business?
Then airfare is not included.
Like he would void the whole thing?
The whole thing, yeah.
Okay.
Because he's keep going personal thing.
So he'd have to technically go back home first.
Go back home, enjoy your family for a few days, and then go back another trip.
Got it.
Or pick up your family and then go. Okay, so what else? You can read the other 2 examples here, which might be interesting, but just because we don't have that much time, I like to get something else covered. Definitely there are good information here, so read it when you get a chance. So let's do this one. Edward attends a trade show in Paris, France, that begins on Tuesday and ends on Friday. Tuesday Wednesday, Thursday, Friday. That's 4 days. With no meetings on Wednesday and Thursday. Oh. So the meeting is just on Tuesday and Friday. Okay. So Edward travels to the trade show on Monday. And returns home on Saturday. So he goes on Monday and returns on Saturday. Okay, so Monday and Saturday is kind of the, transportation day. The trip lasts less than 8 days. Therefore, for this outside the US trip, all qualified travel expenses, it should be less than 8 days to have qualified travel expenses counted, and from his home to trade show are deductible for the whole thing, right? Because it's less than 8 days. The rest of the expenses must be allocated between the 4 business days. So Monday, which is the traveling day, first day is a business day. Tuesday, there is a meeting, it's a business day. Friday is a meeting, it's a business day. And Saturday is a business day because he's coming back. And the 2 personal days are Wednesday and Thursday. So we are talking about 4 out of 6 business days, 4 out of 6. Monday and Saturday count as business days because for purpose of allocating expenses between business and personal activities, both days spent traveling count as business. Okay. Neither Wednesday nor Thursday business day because Wednesday is not followed by a business day. Okay. And Thursday is not preceded by a business day. So the trick is this looks like. If you have meeting every other day, then you have no choice. There is no personal day because you have to wait till the other meeting. Make sense? So that shows that you have to have a very good documentation about your plan, your travel, your business, the location of every meeting, the time and date of every meeting, and who did you meet, how many hours. So it has to be kind of fully documented thing. So you can use all those. Otherwise, so many people like to use France business as a good excuse to go to Paris and have fun over there. So that's why it has to be very sophisticated. Yes.
There's no minimum meeting time to meet with someone for a business meeting, right?
I don't think time is the excuse because you have to meet. It can be 1 hour, it can be 3 hours, doesn't matter.
It can be 30 minutes.
Can be 30 minutes. Still, it's a business. Yeah. But he had Wednesday and Thursday all to himself because it was not followed by a business meeting. So it's not business day, it's a personal day. So here, Tadra is a panelist in a training seminar in London, England. She's gone for a total of 11 days. Okay, that's not good, right? I said less than 8 days is good, but now it's 11, of which 8 count as business days. Since none of the 3 exceptions apply, Tadra must allocate all of her travel costs between business and personal days. So he has to allocate. Of her travel costs, 72.73%, which is 8 out of 11, are deductible. 27.27% are not deductible personal expenses. So it's on his own. If Tadra's employer reimburses her for her trip, she subtracts the amount of the reimbursement from the deductible portion of her travel costs. So she might get reimbursed to some degree if she gets, after calculation of what the travel cost is, she has to deduct the portion that she gets reimbursed and the rest will be deducted. So there are two rules that says the convention must be related to the business, and it should be a good reason why it's outside of North America. Okay, in regards to meal, again, I said it's 50% limitation starting 2023, and just for 2021 and 22, it was 100%, assuming you buy it from restaurant directly. Now, if you prepare yourself, let's say you go to Smart and Final and buy material and you cook it yourself, that's not 100% deductible. You have to order it from a restaurant, delivered to your business. That is a restaurant order. And that was only in 2021 and 2022 regarding COVID situation. But other than that, it is 50% limitation applies to meal orders, and there is no more restaurant specific limitation anymore. Makes sense? The word restaurant was only emphasized during 2021 and 2022. Okay, so we have other expenses, obviously. Like what? Like education expense is other expense, business gift, dues, and subscriptions and bad debt. Those are kind of things that you might call it other expense. But education expense, be careful. Education expense is only acceptable if you are spending that tuition and books to improve your knowledge for that line of business. If as a form of professional skills that you have to maintain. Make sense? Let's say if you are preparing taxes and you take this course as an individual tax return refresher, then this course will be tuition deductible. But if you are right now working in, let's say, McDonald's, or let's say delivery, let's say DoorDash, schedule, you are independent contractor, right? So you are working in DoorDash as an independent contractor, and then you take this course in order to become CTEC approved, so you can get an opportunity to become a tax professional. That is not deductible education expense because you are trying to get a new job. But you can use that education expense as lifetime learning opportunity credit, which is non-refundable.
But if you use it for this, you can't use it for lifetime. You can't do both. You don't do it.
No, there is no double dip. No. You have to say, am I going to use it as a DoorDash independent contractor education expense? Which you can't, because you are doing this to get a new line of business, or you are a tax preparer already, but you like just to get a little bit, updated on tax, maybe learn corporate tax, maybe learn partnership tax, something like that. So you are improving yourself to stay in that business that you are and become more knowledgeable. So that is so-called business expense, assuming you are a Schedule C independent contractor. Other than that, your education can be used either for lifetime learning expenses and get a non-refundable credit, or American Opportunity Credit if you are continuing your education for a bachelor's degree. Okay, so we are good, I think. And here is the example that you can read, but it says the same thing I just said. This is a good one. It says same fact as in example 21, except that the classes Rains is taking are in pursuit of Master of Taxation degree. Since completion of this degree prepares Rains to be a tax accountant, which he already is, the education is not preparing him to enter into a new profession. Instead, the courses help him improve his skills in his existing profession. Therefore, Rains can deduct the whole book tuition, as another expense on Schedule C. So he's a Schedule C CPA, tax preparer, and now he's taking master in taxation degree. Make sense?
He was trying to, like, if he was a tax preparer and he was trying to be an auditor instead, and he was taking audit courses, would that technically still be in the realm of being in that field since it's similar, or no?
No, he's trying to, I think you can argue that because still a CPA can do audit, but you are trying to get master of probably not taxation in that case,
NACC maybe?
master of professional accountancy. But in the previous example, he was trying to get something else. Let's see. Yeah, new profession. So he's trying to get a law degree. So he's a CPA, now he's trying to change his work and become a lawyer. So that's why it's not, he's changing work. If you are trying to change your work, then it is not going to be Schedule C education expense, but it will be qualified for lifetime learning. Okay, gifts. The maximum deduction cannot exceed $25 for business gifts given to any one person during the tax year. So remember that. That's kind of thing that good to remember. But have you seen those things that when you go to somewhere, a meeting, they give you bags or cups or pencil, pens that has a marketing material on it? That is deductible business expense to prepare those. It's just marketing, so it's good. Those are something that will be about $4 or less, something like that. So that cost can be used.
Like last Friday, right?
Yeah, last Friday we went. They gave us backpack, but it was a cheapy backpack, right? It was not like one of those fancy $70 backpack. It was very nice, but cheap, less than $4 cost. Yeah, so write-off, let's see, I just saw write-off somewhere. Oh, I talked about this direct write-off is permitted if you are an accrual method of taxpayer and you recognize the revenue when you earn it, right? You recognize the revenue when you earn it, but what is the journal entry when you recognize the revenue when you earn it? Anyone? Bookkeeping a little bit?
It would be revenue and then accounts receivable.
Debit, accounts receivable, credit, revenue, right? So you record that. So you record the revenue and you pay taxes. After 6 months, you cannot collect it. Still, you are like hopeless. So now IRS says you can use direct write-off method. Let's say that happens in November. You recognize debit, accounts receivable, credit, revenue, and you pay taxes for it, right? But 6 months later, in the middle of summer, you realize this guy is bankrupt, gone. So you can do direct write-off and write it off. And the write-off is debit, bad debt expense, and credit, accounts receivable. That way the accounts receivable is closed and you recognize the bad debt expense in where? I passed it, it was previous page, but bad debt expense is part of what? Part of other expenses in Schedule C. Here. Schedule C. Where is Schedule C? Here, line 27A, bad debt expenses. Make sense?
You have to report ADA anywhere or no?
Do I have to report what?
Allowance for doubtful accounts anywhere or no?
Allowance for doubtful account will never, ever permitted under tax law. That is under GAAP for bookkeeping purposes. But the moment you are preparing your taxes, right? The moment you are preparing your taxes, that allowance and the bad debt expense that you recognize because of that allowance, journal entry on December 31st has to be eliminated from your tax expenses. The only thing can stay in your taxes. Let's say you recognize $1,000 of bad debt expense in December 31st, which is debt under allowance method for bookkeeping. You recognize, let's say $1,000 debit, bad debt expense, credit, allowance for doubtful account. That is allowance method, right? So you recognize bad debt expense for something that didn't happen yet. IRS says, no, wait, I'm not gonna accept that. It didn't happen yet. So take that $1,000 away. You say, yes, okay, I take that $1,000 away. But just a few months ago in summer, I had a customer that I recognized the revenue a year before that, but in summer I did direct write-off. IRS says, okay, that $300 direct write-off, bad debt expense, that's accepted. So this is the moment that your bookkeeping numbers under accrual method is kind of not matching with your tax numbers under tax method. So there will be a difference. So you will see, maybe in the book comes up, you will see a financial statement that looks good, but when you are preparing your income tax return, some of those things in your financial statement is not permitted. Like what? Let's say you had, remember last week we went to that Deloitte and it was like a business expense, something. So they bought us food, right? It was a meeting, and they bought food. So the food, $1,000 food, it is tax deductible for bookkeeping purposes because it's entertainment. But when it comes to tax, it says, no, it is 50% acceptable for entertainment. I mean, for meal, not entertainment. Entertainment is gone. It's not acceptable whatsoever. But meal, 50%. So that 50%, now is different because the food they spend is $1,000, but now they can use only $500 for expense. So those are things that you have to be careful. Any question about direct write-off or anything?
Actually closed also today. So if you're a mechanic and you require certain clothes, the clothes have to be work related.
Yeah.
Right? But they can't be clothes that you normally wear like on the street.
No.
Okay.
No. Like for example, this clothes that I'm wearing right now is not an expense for any reason because I can wear the same thing in a birthday party. Personal thing. So if it's a uniform or specific boots for work, yes, that's expense. But something that is general type of clothing is not accepted as a business expense. This is about a loan. Okay, so if you loan someone, and he can, like you loan to your friend, and he will not give it back to you because he's bankrupt, whatever. You cannot write it off, say, oh, that's a bad debt expense. But in this example says Tim's loan to his business supplier was because he wants to keep his suppliers in the business, and he gave him some loan. That is because you don't want your supply chain get disrupted. So it's a business related loan. It's not because he's your friend loan. So it's a business related loan, and then that business eventually went bankrupt, and so he couldn't collect anything, or he just collected 15 cents on a dollar, right? So if he collects only 15 cents on a dollar, then he reports $4,250 as bad debt expense in other expenses in Schedule C. So you go to Schedule C and you add it to line 27A. If he later on barely got only $300 back from bankruptcy court, then he will add another a little bit more. Previously, he wrote $4,250. Now is $4,700. So what's the difference? $350, whatever. That difference again will be added to the next year's Schedule C. Make sense? Because he has more bad debt expense. However, let's say Tim receives from bankruptcy court $1,000 back instead of just 15 cents on a dollar. He got $1,000 back. So instead of 300. So the bankruptcy court gave him more money. Now he has to say, okay, the bad debt deduction should be only $4,000, but he deducted $4,250 in 2023. So requires that $250 as other income will be added to Schedule C because he got a little bit more money than he was supposed to. Make sense? So if you get more money back, you have to record as a revenue. If you get less money again, more than what you think, then you recognize more bad debt expense in that year. So it's kind of continuous situation. One more thing that you will be really busy with, client will come to you with business use of home. The short answer to this situation, if they have a business home, like office, it's like I have a home office too. But can I, let's say, assuming I am an independent contractor, can I use this home office deduction? No, because college is providing me an office. Now, if I really like to do in my home because it's more convenience, that's my problem. Because here I have an office already given to me with a computer, everything. So guess what? I don't have business deduction. I have a computer provided, I have an office provided, so I don't have computer expense, I don't have office expense whatsoever. So if you use your business office, it should be for a good reason. Let's say you do some deliveries or whatever outside, and then you come back home and you do invoicing. again, you do outside work and then you come back home, you do invoicing. That is a good reason. So you have a business home. The best way to go with this, and easy and best way, I believe, is using safe harbor, which is a square footage up to 300 square footage times $5 per square footage. And you use safe harbor. So you choose in the software safe harbor, business home use safe harbor. Okay? And that is maximum 300. If your office is 200 square feet, then you have to say 200 times 5. But if your office is 350 square feet, you still can use maximum 300. And the good thing about this,
The max is 300 square.
max is 300.
Max is 300 per square feet for home office?
Safe harbor, yes. Under safe harbor. Safe harbor. It's probably in another page. Here. So safe harbor can be used by renters as well as homeowners. That's a good thing, right? So everyone can use it. Square footage of both home office and the entire home plus the amount of deduction and Schedule C. So that's a good thing. The other good thing about safe harbor is you are not technically using depreciation expense. And if you are not using depreciation expense, that means you are not reducing the basis of your home. Because if you start depreciating your home, then the basis of your home is keep going down and down. Let's say you bought your home for $200,000. Now you're depreciating your home, so your cost of your home goes down. Now, if your cost of home goes down and then you sell it one day, the capital gain will be much bigger, right? And also just remember, for your personal home, you have up to $250,000 exception from capital gain if you are a single, and if you are married, 500,000. That means 250 times 2, up to $500,000 exception, right? But if the capital gain goes above that, one of the reasons is because you start depreciating your home, and that depreciation will reduce your basis. Which is not saying that in this book, but I'm just telling you so you know. But other than that, if you like to use your home, you have to see how much you are using. Let's say there is an example here, I believe. Yeah. So Jennifer provides childcare in her home. The area of home used in her childcare business is 40% of the total area of the home. Okay, keep that in mind. For 50 weeks, 1 year is like 50 weeks, 52 weeks, but 2 weeks is vacation. So 52 minus 2 weeks vacation is 50 weeks. Jennifer provides childcare service 10 hours a day, 5 days a week. So 10 hours a day times 5 days times 50 weeks. That's 2,500 hours in 1 year out of 8,760 hours in 1 year. So that gives you a ratio. So that ratio multiplied by 40% ratio of square footage that you are using. So you are multiplying two ratios together, and you end up by having 11.42% ratio. So 11.42% of the home expenses will be deductible for this home office. And there is another issues too. That's not only thing. So let's look at this example so you can understand what it means.
Is the 8,000, the 8,000 is the total hours of the year?
8,760, yes.
What if it's a leap year? Is it a leap year?
Just do the whatever it is, calculate the hours,
So you'd have to change it based on that specific year.
change it, yeah. But in general is 8,760. The idea is to getting the ratio of hours that you use the area, and the area you are using is 40% of your home. So you have two ratios now, 40% of your home plus a ratio of your hours. Multiply is 11% in this example.
Use that 11% for the expenses related to this.
Yes. Now let's talk about expenses. What expenses we are talking about? So we are talking about what? Let's say repair, utilities, real estate tax, mortgage interest, home insurance, repair and maintenance, and depreciation. And the depreciation for the residential property is what? 27 and a half years straight line depreciation, right? And based on what you purchased that for. The tentative profit from the business is $3,300 net income, right? So Morgan computes net income derived from business as follows. Tentative profit from business is $3,300, but now we are trying to figure out how much we can deduct for office. So the business portion of mortgage, interest, and real estate, that is step one. Step one, mortgage and interest. Real estate tax and mortgage. Mortgage interest and real estate tax. That's step one. So you go and deduct, let's say, 20% of, the ratio that you use for the real estate and mortgage. That's 2,200. So still good because you can deduct it from 3,300 tentative income, and you can use still $1,100 to deduct other home actual expenses. So step two is other home. So first thing, you deduct mortgage. Second, you deduct other expenses. Other expenses like repairs, maintenance, insurance, utilities, a percentage of it. That's step two. Step three is the last thing, which is depreciation. So depreciation is the last thing. Why you go with steps? Because we don't know how much income you have from your business. You can just deduct up to that specific income. You cannot show loss. Make sense? You cannot use office expenses as getting to the point that you say, oh, I have a loss in my business. Got it?
What happens if you have multiple businesses that you do and use in the same space for both businesses? You have a home office and you're
multiple businesses, then you combine those business income. Or you can use, I think, because you're gonna have different Schedule Cs, then you can say, okay, because I have different Schedule Cs, the tentative income of business number one compared to business number two and business number three. Combined is 100% of income, right? But what percentage belongs to business one? What percentage belongs to business two? What percentage to business three? Based on the revenue. Make sense? So, but here we have just one business, so we are using that as 100% of our income, and we are deducting. So we deduct that 2,200, but still we have $1,100 left. The next step is deducting what? Regular expenses like maintenance, repairs, insurance, utility. And the last thing is depreciation. So keep in mind, Here is the form for expenses of business use of your home. You see, now we have a form. And remember I said safe harbor is really easy and convenient, and you're not gonna reduce the basis of your house because of depreciation or anything else. But now, if you want to do the actual expenses, it gets complicated. And if your client says, no, I want you to use actual expenses, then you say, no problem. But guess what? The fee is different. The fee for your services will be different because you are spending more time now. So here is the form that you can look at it later on, but I want to get to this part. So remember we had $1,100 left, right? So utilities, insurance, and repairs are 20% of whatever it is. So that's $1,260. Depreciation of home office is 20% of the annual depreciation, which is $900 only depreciation. So total other home office expenses is $2,160. But remember I said, first you deduct step 2, which is other expenses, and then depreciation at the end. So yes, you can deduct $1,100 from this, but that $1,100 is coming from taking a portion of what? A portion of repairs here and nothing from here. So that $1,100 will be just enough barely to cover this utility, insurance, and maintenance, not anything to touch the 900. So 2,160 minus 1,100 is 1,060 carry forward to the next year for deduction home office, right? But you have to know what is that 1,060 coming from. That 1,060 is $160 regarding other expenses and $900 regarding depreciation that you are carrying forward. Got it? Why is it important? Because next year, the first thing you can deduct is what? Mortgage interest and property tax. Second thing that you can deduct is what? Other expenses, including this $160. The last thing you can deduct is the depreciation of 900 that you are carrying forward from previous year, plus whatever depreciation you have in that year. And that all depends how much income you have. So you constantly have to carry forward and keep the record keeping, and it gets complicated.
A lot of work.
A lot of work. So you're gonna charge your client a lot of money for this. So your client has to decide, hey, do you want to use actual expenses, or, I'm gonna use safe harbor unless you insist, which takes a lot of extra work. I will do it. I don't care. I'm charging you on my time. Yes.
My uncle does construction, so he has a home office, but then he also I think paragraph above, talking about inventory, store inventory. So sometimes he has cement and plywood in his backyard, and that adds that space. So in this case, I guess it would work out. Safe harbor would.
Safe harbor is up to 300 square feet. If you are not happy with that, then you have to go with actual.
Right. But sometimes he does have big machinery, he has a bunch of tools, and sometimes he has big inventory.
So maybe he is not happy with safe harbor then.
Yeah.
He might say, okay, you know what, I pay you extra, whatever you charge me, but I want you to use actual expenses.
Okay.
Just your client needs to understand, actual expenses and safe harbor is not the same charge.
Yeah.
You are charging for your time, so it's different. You have to, manage all these things and carry forward every year, if necessary. Here, although the one drawback of safe harbor method is 1,500 limit placed on the deduction, the safe harbor method has its advantages. In addition to being an easier deduction to compute, taxpayers who use safe harbor method do not have to complete Form 8829. Instead, they report their home office deduction directly on Schedule C, line 30, which is that line, line 30, right there. Second, in the years the safe harbor method is used, taxpayers do not have to keep receipts of the various expenses related to home. Third, the depreciation component in the $5 per square foot amount is assumed to be zero. Got it? That means you don't reduce the basis of your home. We assume the depreciation will stay zero and you never reduce the basis of your home. So you don't need to track that. Therefore, in years in which the safe harbor method is used, taxpayers do not reduce the basis in their home by any depreciation taken from home office. You just copied my rule. I know. Okay. We got the idea so far? Questions? Yes.
What kind of evidence do the clients have to show you for a home office? Or can they just say they have
Actual expenses? Or safe harbor?
or safe harbor?
Safe harbor, you just need to have a plan of your home. You can draw it. And you can emphasize which section of your home is what. And then you can show exactly where your office is located and show the square footage. Write it down on that plan and put it in your documentation and enter it in this area that Schedule C, that what is your home square footage right there and what is your office square footage right there. But in order to prove that, you have that plan. So in case you get audited, you just take it out and say, here is the plan. You need the plan anyway, so kind of to know what's your square footage of your home, where is your home office located.
Up to 300 feet, you cannot exceed that.
No, not, no, 300. Okay, so here is an income statement that a client will bring to you. Says, hey, this is my business, this is my income statement. And you need to figure out what in this income statement can go in Schedule C. Got it? It's your job to do it. Some customers, they don't even have this. So that's another charge for bookkeeping services for you to do the bookkeeping and have this income statement ready at the end of the year. Make sense? So that's another source of income. So that's why you have to take the bookkeeping courses, right? So now, assuming that he will bring this to you. So now you have to identify what expense is gonna be included, even what income is gonna be included in Schedule C. So let's look at, this is a multiple step income statement. It's kind of bookkeeping type of thing, but it starts with the sales and then minus sales return and allowances, minus sales discount. It gives you net sales. And then on the left column, you need to calculate what is your cost of goods sold. And in order to know what the cost of goods sold is, you need to know what is your beginning inventory plus purchases minus purchase discount gives you net purchase. Net purchase minus anything that you take it from that merchandise for your personal use. That gives you net purchase of 176,000. 176,000 plus beginning inventory of 131,000 gives you 307,000 available, and 307,000 available minus end inventory, which you need to do audit on that, to get the end inventory count. So you count the end inventory, reducing from the available gives you cost of goods sold. And this is, in case you want to remember this is base, B-A-A-S-E, beginning, added, available, subtract, end. B-A-A-S-E, I call it base. That's following the base method. So beginning, added, available, subtract, end. So available is 307, end is 167, then subtracted and sold is 140. Got it? So gross profit is cost of goods sold minus revenue. That's your gross profit. Then after gross profit, you deduct operating expenses. You have two types of operating expenses. They are either selling expenses or general administrative expenses. So you deduct your operating expenses one by one, and then you have operating expenses total less gross profit of 241 gives you operating income 146,000 less other income or expenses. Other income and expenses are like interest income, interest revenue, those type of things. So interest income is 584. Other expenses or other income is separated from operating income because you need to understand what is your operating income and what is the other things that happens, in a business like interest, or let's say gain on sale of equipment, loss on sale of equipment. So those gain or losses will be also part of other income or other expenses. Make sense? So assuming you have gain or loss, will you put this in Schedule C? Gain or loss goes in Schedule C? No, gain or loss goes in Schedule D. D as a David. Gain or loss goes in Schedule D. Interest income, it goes in Schedule C. Interest income? No? Where does it go?
Oh, that's the 1099, right?
No. Interest income. Schedule B, B as a boy, yes. So,
Gain and loss goes to Schedule D?
gain or loss, Schedule D. Interest income goes in Schedule B, B as a boy. So you have to understand, if your client provides you this income statement, you cannot just take it and start putting that in your Schedule C. Got it?
Goes in B?
You're gonna mess up the whole thing.
Interest goes B?
Interest, Schedule B, yeah. Okay, let me show you, since you are
That's where we put
so
like
much asking here. Schedule D as a David. Here. Schedule D. Capital gain or losses. So if you have a gain on sale of used equipment or loss on sale of used equipment, here is capital gain or loss. Schedule D. If you have interest income, let's say, it goes to schedule what? B, B as a boy.
But I thought the gain or loss that was real estate, like
Oh.
capital gains. Because that income statement that you have, why wouldn't that go on Schedule C? Because those are, expenses against the revenue that they earned for the year.
What?
On that income statement that you showed us, the profit and loss statement that
Okay.
you showed us. Why wouldn't that, I don't understand why that would go on the capital, gains and loss, because I thought capital gains and loss that were like real estate and stuff like that.
Capital gain or loss can be from sale of anything, sale of stock, sale of business, equipment,
right.
sale of house.
But this profit and loss has an inventory, so it has cost of goods sold and stuff like that, so that's their business to sell things. So why would that be on the capital? Am I missing something?
Yeah.
Okay.
Then you sell inventory.
Mm-hmm.
You buy t-shirt from downtown LA, bring it to your store, and you sell that t-shirt. Let's say you bought it for $10 and now you are selling $25. So your revenue is 25. Cost of goods sold is $10 for the t-shirt, and now you have cost of goods sold. Are we clear on the inventory part? That's inventory.
Right.
Okay. Put it aside.
Mm-hmm.
Now you have a used equipment. Let's say, I don't know what you do with that equipment, but it's a used equipment. You don't need it anymore. And you sell it in Craigslist. And you have a gain on sale of that equipment because your basis is, let's say, $120 basis, and you sold it for $300. So 300 minus 120 base is $180 gain on sale of equipment.
Right.
That gain of sale of equipment goes in capital gain and losses.
Right, I understand that part, but on the profit and loss statement, was there a sale of equipment that I missed that? Because I don't understand what part of that profit and loss would go.
Gain or loss here. Gain or, I'm saying, you see, it says other income or expenses.
Mhm.
Other income or expenses is like what? Like interest income, interest expense, gain on sale of equipment, loss on sale of equipment. Those are other things that might happen in a business, but has nothing to do with
Okay.
selling t-shirt.
That's what I missed.
Selling t-shirt is operating income, which is $146,000 right there. That is my selling t-shirt business. Got it?
Right. And that's so everything from that part up is going into Schedule C, but the other income, whether it was a gain or a loss, that's going into the other schedules. Is that what you're saying?
Almost, but not
Okay.
exactly. All I'm saying, first thing, I'm saying this part, then I'm gonna go up there. I'm
Okay.
not up there yet. Up
Okay.
there, we have another thing. Let's
Okay.
cover this part. Anything below operating income, let's say interest income, goes into Schedule B.
Right.
Like gain or loss goes to Schedule D. So if someone gives you this, I'm saying, don't just put it next to your computer and start entering all these expenses into Schedule C. God bless America. Everything goes into Schedule C. It's not like that. You're gonna mess up the whole thing. For example, I told you last time, remember? Let me show you again.
Rent expense.
Let's say line 15. If you have liability insurance, goes in line 15. If you have health insurance for your family and yourself, not for your employees, okay? For your family and yourself, health insurance, don't put it in here. That goes, health insurance of self-employed goes into eventually Form 1040 in one of those schedules.
If you're paying to buy your own health insurance, that goes in the other thing. But if you have a plan that you are paying for health insurance for your employees and you're part of that plan, wouldn't that go under Schedule C if you're getting it through the company?
You separate that.
Yeah.
You separate your employees' benefit
Mhm.
expense. Employees' benefit expense goes line 14. No, yeah, line 14. Employee benefit expense, which you offer health insurance to your employees, goes line 14. But your your health insurance goes somewhere else, eventually in Form 1040.
Right.
Just,
Personal?
where is it?
Is this personal?
I'm talking about personal. Yes, right there, line 17, thank you. There, line 17.
But what-
Self-employed health insurance.
Does that also happen if you have an LLC and you're paying yourself, a salary? Would you still put your health insurance in that?
No,
It will be covered under the benefits of the employee? If you're paying yourself a salary?
no, if you have an LLC will file taxes
So it's a whole
himself,
different thing.
and they put it as a employee benefit
Okay.
expenses, yeah.
So this is just for, okay. I just confused myself, but it's okay.
No, yeah, we have to, these are things that, so many things we are learning here. I'm saying, don't try to learn it too much because eventually software will do it for you. Remember? I said, don't memorize. I'm not memorizing this. I'm trying to teach you, but I'm not memorizing it. You ask me 5 minutes later, I don't know. I have to open it again. But there are things that software is not doing for you. You have to have 100% understanding of this because you're going to mess up the whole thing and software will never know that. So this is the moment.
So the Schedule C is is it just for like sole proprietorships or partnerships? Because you're saying LLC doesn't use that schedule.
Partnership, you file a partnership tax return. I think it's 1065.
Okay, and then when you file that, do you get a Schedule C from that to file your personal or no?
No, when you file a partnership or LLC or S Corp, let's say, those are kind of pass-through entities in most cases, right? So a pass-through entity means you have to prepare a business tax return, put all those expenses inside, and then figure out what is the net income. And then whatever the net income is, then you issue when you are preparing the company's tax return, then you issue a K-1 form, and a copy of K-1 form goes with the tax return of business into IRS, and IRS knows that you are 50% shareholders and you are 50% shareholders, and each one of you got a K-1 form, and let's say net income is $100,000. So out of that $100,000, 50%, which is $50,000, your responsibility to bring it into your individual tax return and show that K-1 form as form of income, and another 50% goes to other shareholder.
So then
This is only sole proprietorship,
Okay, got
nothing else.
it. Okay.
Remember, we are teaching this class is individual taxation, not business taxation. I mean business like S Corp
Right.
or LLC or C Corp or no, we are not teaching that. But you will have clients that they will bring you a K-1 form. Just like a W-2, they have a K-1 form. And you have to enter the K-1 form into the software as another source of income that you are responsible to pay taxes for it, income tax for it. Okay. So bottom line, I want you to understand. Now, let's go to operating expenses. So we talked about what? We talked about other income. We talked about gain or loss. We talked about it. We know that they're not going to go into Schedule C. But how about these operating expenses? Okay, so operating expenses, you have to be careful. For example, I go down. Oops. Look at that. I put red. You see that red one? That doesn't go to Schedule C. Okay, look at this one. How about that? Does that go to Schedule C? Yes? 50%, not 350, 50%.
So like he was
So
saying.
be careful, bottom line, that's what I'm trying to say here.
Okay, but like he was saying earlier, so like you have this example and it has mill expense 350. We have to do the calc, cause I know like in like TurboTax, if you do that, they'll take the 50%, they'll do the calculations for you. Do we have to-
Automatically, yeah. There are some softwares that they babysit you.
Mhm.
If you have to know what your software is
Right.
doing. Some softwares, they are not babysitting anyone. Either you know what you are doing or you don't. So if you look at the professional software,
Mhm. They don't babysit.
no, they don't. They just say, okay, do whatever you want to do. You know what you are doing, right? If you don't, then says, okay, go buy TurboTax. It looks like you don't know what you are doing. But so if you see you put 175 and then your software is multiplying 175 by 50%, then you say, oh, wait a moment. Looks like I'm getting babysit here.
Mhm.
So you go back and you delete 175, you put 350 because you know software is taking care of you.
Okay. But the
So-
software that we do doesn't babysit, we have to do the calculation.
As
That's
far
it,
as
that's
I
what
know, it doesn't babysit.
Okay.
Again, not 100% sure, but 90% sure that is not babysitting. But TurboTax, and there are some softwares that they are used just specific for people who are general people and don't know what they are doing. So that's why they are asking so many questions constantly to make sure that they push you through the right direction. Anyway, so let's move on, I believe. Time is off. How much did I count? Profit and loss. Okay, so this is the, Schedule C example again for that problem. So you can study at home. This is the fill up the portion of the Schedule C again. Self-employment tax. Remember, self-employment tax, it is, you're gonna calculate what the self-employment tax is, but 50% of self-employment tax will be deductible from your income down the road. There is that. Here. So, yes, you will end up by paying self-employment tax, which is for what? For Social Security and Medicare. Social Security, you have to pay the whole thing, 12.4%, and Medicare, you have to pay the whole thing, which is 2.9%. 12.4% is up to $147,000 threshold, and every year is changing. But Medicare is 2.9% forever. Doesn't matter how much money you make, you have to pay 2.9%. And if you, as a single person, you make more than $200,000, you pay additional Medicare of 0.9%. So now, because you are the employer yourself, it's independent contractor. So government says, hey, I know you are employer yourself, and normally employer has to pay half of the Social Security and Medicare. Now you end up by paying the whole thing yourself. So we feel bad for that. So we're gonna give you a deductible of half of the self-employment tax from your income. So that will make everything even. So no one gets penalized for no reason. Make sense? And then here your book is giving you an example about self-employment tax calculation. Again, you might want to know how to calculate. Yes, you have to read this, right? You see that? Kind of know how to calculate, because you're not calculating based on 100% of your income. Why not? Because remember, whatever your income is, technically you have to pay 6.2% plus 1.45% as a total will be 7 point something, 7.65. 7.65% of that income is a deductible item, right? But you don't have a chance to do it because this is your own business. So that's why when they want to calculate your self-employment tax, they say, okay, 100% of your income minus that 7.6%, what is left? 92.35%. Now we're gonna multiply that 92.35% of your income multiplied by Social Security tax and Medicare tax. Got it? So you don't get penalized on that corner either. So that's how it is. But again, you're not gonna do it. Who's gonna do it? Software will do it for you. So do you have to kind of know this 100%? No, I just say this is how it works, but you don't worry about it. And here are some examples for that. So you can read that. And I told you that self-employment tax will be 50% deductible later on somewhere, right there, Schedule 1, Part 2. And here is the Schedule C that you have to fill up. The software will do it for you for the taxable portion of the income and how much will be the Medicare and Social Security taxes. And here is the example of Schedule SE for you to see how the calculation works. And here is an example of scenario that you might want to practice it, but the answer is given anyway. So you can compare your practice with this. And here is chapter 7. Okay, let's take a break. And we are going to, during lab hours, prepare taxes from practice lab. Okay?
I'm here.